Welcome everyone to another episode of Smokin Bulls, the podcast about business, money, and lifestyle. I'm Tyler.
I'm Dave.
And today we have the pleasure of speaking to ICM Asset Management, an alternative asset management firm based here in Canada. So without further ado, let's get into it. So as I mentioned, we're joined by ICM Asset Management today. I wanted to thank our speakers today for attending. We've got Mike Baker here from ICM Asset Management. We also have David Vankka from ICM. Before I turn it over to Mike, I'd want to do just a brief preamble on who Mike is to us. He's kind of boots on the ground for ICM Asset Management. He's actually been on Smokin Bulls before. Mike, you were with us back in, I think it was May of 2021. So thanks very much for returning to the Smokin Bulls podcast. Mike's been a great supporter of our business. He helps us understand the strategies that ICM offers. And they've got a new strategy, or relatively new strategy, that we think is a really cool fit in client portfolios that we're going to talk about today. So, Mike, I'll turn it over to you, and thank you again for being here.
How the space works is essentially any time that a title is played across the digital ecosystem, a royalty right is created and paid to that rights owner. So each individual title will basically be assigned its own unique code that tracks it through the kind of playing and streaming ecosystem, which basically means that the underlying owner of that IP will get paid a royalty right regardless of where it's used. So in its simplest context, I mean, you could spend hours talking about IP law. It's one of the more complex subject matters out there, but the simplest way to explain it is every time a song is played, streamed, used in a commercial, played on the radio, etc., a royalty right is created and paid to that rights owner. So the strategy that we've built here is really around taking capital, deploying that capital into acquiring catalogs of these underlying titles, and then paying our investors a cash flow stream based on the royalty payments that are paid to us from the ownership of that IP. And there's a couple of reasons why investors have kind of flocked towards this asset class, and I won't spend too much time here, but a couple of the important ones would certainly be from a correlation perspective. The income stream that we're providing for our clients is really not correlated to anything in the broader markets, both fixed income or equity, or what's going on in the broader kind of macroeconomic world, right? Our income stream is largely driven by consumer behavior. The space is growing very quickly. Dave will kind of touch on what's happening in the asset class and the streaming space. But a couple of the more notable things that I think we should touch on is that royalty rates are predetermined. And what I mean by that is that the actual payments that are being paid to us on a percentage basis are set by government statutes, which dictate effectively what portion of each dollar of streaming revenue has to be paid to the rights owner. So it's a highly regulated space. And then the other piece that I want to really touch on here is that the music royalty asset class is likely to be one of the longest lasting asset classes that somebody will encounter. When the way that IP law works is that before it becomes public domain, the owner of that IP will get paid for the life of that artist plus 70 years. And this is a concept that's, in many cases hard to kind of wrap your head around, because you're talking about an income stream that can last for 100+ years. So we've really found a niche market here and a strategy that's worked really well over the last number of years by basically just paying a multiple on acquiring a trailing cash flow stream and then giving our investors a future cash flow or a future distribution based on the ownership of the underlying music IP. So I'm sure you're going to have a ton of questions, and there's tons to dive into here. And so what I'd like to do now is maybe I'll introduce a colleague of mine, David Vankka. David's one of the partners at ICM and would also be the lead portfolio manager for this strategy. So his job is not only to manage the portfolio, but also go out and source deals, fill acquisitions, et cetera, et cetera. So he'll be in a great position to answer the many questions that I'm sure you'll have.
Great, and thanks for having us on today, and really appreciate the time. And as Mike said, it's a unique asset class, and it can sound a little complicated from the top, but at the end of the day, what we're really talking about is somebody writing a song, creates what's then a musical composition, which is actually a piece of intellectual property, and then that song gets recorded in a sound recording that you would listen to, and then that is also a piece of intellectual property. And those two items are effectively the foundation for how this all works, as Mike said, meaning that, anytime a song is licensed in a video, played on the radio, played on your streaming service, performed in public, both the writer and the recorder of that song generate some royalties from the top. So that's really what we're focused on, is trying to acquire a diverse group of these music catalogs from different artists with these great cash flow streams that we think are going to continue to accrete over time. And what we're not doing, just to be clear, we've all got our own passion and interest in music, but what we are not doing is trying to identify new artists, sign new artists, and help develop their careers. So we're looking for music that has some track record that we can, have some confidence in continuing, versus a new artist which may or may not be successful down the road. So hopefully that's a nice overlay in terms of how we approach the entire space.
You mentioned very briefly, Mike, and maybe you can touch on this, David, is that governments are dictating the royalty streams. I'm curious which governments would be involved there. How does that, is it based on where the artist is domiciled, or what government would step in and indicate what type of royalty is going to be paid out?
Well, if you think about it from the beginning, let's just say we're songwriters writing these songs. The ability for us to go and have a reasonable negotiation with Amazon and Spotify and these very, very large entities is impossible. So, since, way back in time, it's really been driven by the US Copyright Royalty Board, who sets these particular standards. And then internationally, there was a convention many years ago where a lot of the international players will follow suit. So and in terms of the streaming market in particular, the US is still the largest market for streaming globally. And that's something we can touch on, what's happening around the world in that space. But yeah, really, it's the US Copyright Royalty Board. And, in fear of getting too deep in the weeds, they increased this rate from 10.1 to 15%. 4 years ago, there was a 4-year appeal that happened with groups like Spotify and others. And it was turned out that ruling was upheld. And now they've set it for the next 4 years at 15.3%. So without appealing. So what's happening is, I think the industry, including the digital streaming providers and the large players, are starting to appreciate that more money should be going into the hands of the songwriters and the artists, for, who are ultimately creating the work and creating the music that makes the whole system go around.
So I guess your slippage would happen. I mean, if I'm in Africa and I'm listening to Spotify, royalties are being paid. If I'm in Indonesia and listening to a radio station, potentially without an agreement, royalty wouldn't be paid, or it's slipping through if there's no agreement.
Well, there would be an agreement, because those radio stations do have to license that music as well. So, but what happens is, from a collection standpoint, is that it all gets centrally collected through a publishing administrator, or through a writer's performing rights organization, or through a label, so that they collect the royalties from these 4 jurisdictions and submit back to us. So when we have a catalog and we get paid on it, we might have 500 or 1,000 pages of things that do say X happened in Indonesia, X happened in Venezuela. But at the end of the day, it all gets aggregated into one fund for us. So it's the volume of data that's coming through the system now is there. I think, the industry has had slippage historically, meaning that, one, there are cases where they don't really know where to pay the songwriter. They don't know who it is. They want to pay. They just don't know how to get a hold of them for whatever reason. And then the second case, which is starting to narrow, is that if a streaming provider says you did 1,000,000 streams, did you really do 1,000,000 streams or did you do 1.1 million streams? So now as technology is moving in, they're starting to have companies that are focused on auditing these streams and the like. So I think that band narrows over time, and we sort of view it as upside for the portfolio, because when we acquire something, we just look at the net numbers that are coming in and forecast off these net numbers. And what we do know is they're not being overpaid. If anything, there's a little bit of shrinkage in there. So as technology continues to infiltrate the industry, more likely that more of these royalties are going to be captured in a more timely manner, because there is a lag between when something is played in Indonesia and when the money actually gets to the artist or to a catalog owner like ourselves.
It sounds like similar to the Alberta problem we used to have before technology, is how much oil is really coming out of that well and how much water.
You go to the wellhead,
went up.
check the gauges, send me the S reports. Yeah, it's definitely
for technology. It's a little higher now.
Yeah, it's definitely changing. And then even just with the industry, you mentioned these foreign jurisdictions. One of the things that's kind of happening globally is there's still a lot of growth forecasts, particularly out of the streaming side of the equation. And there's like Goldman's one of the main researchers in the space, and they're forecasting sort of a 7.5% cumulative annual growth rate till the end of 2030. And some of that is driven from the rest of world, so to speak, increasing the amount of streaming that they're doing, either adopting streaming or increasing streaming. And, companies like Spotify have been entering more and more countries to do that. Obviously, the subscription someone pays in India is going to be less than the subscription someone pays in the United States. But the market share, continues to grow. So we sort of like that dynamic tailwind as more and more people are sort of adopting the streaming model going forward.
Now we got the technical questions out of the way. Let's get to the...
Well, yeah, I'm kind of wondering where you source deals. We hear about artists selling their catalogs, and I don't think that's what this is. You're taking part in the artist's ongoing revenue. They haven't sold a catalog. Is that right? Or are you looking at catalogs that are sold?
We would be acquiring a catalog from an artist, so they would sell it to us, is what would happen. And when we say artist, that could be a songwriter. It could be the band themselves that's recorded, or some members of that band. Sometimes they're the same, sometimes they're not. It could be a producer. We even acquired some rights off the estate of a manager who managed Gordon Lightfoot and Janis Joplin's estates. They also managed Bob Dylan, but we don't have those rights. So the pie gets cut up in a few different ways. And we look at sort of all of those revenue streams. But in terms of how we source the deals, a lot of it becomes a bit of a network. Like I think like other industries, there's a smaller than advertised group of people who seem to be involved in the space, and they can be catalog brokers, but they can also be music entertainment lawyers who that's all they do is music law. It could be business managers, or it could be artist managers. So then it becomes a bit of a word of mouth. And because we've done 20 transactions already, and we think we've demonstrated that we're good to deal with in terms of closing and doing what we're going to say we're going to do in those transactions, we start to get the word of mouth or referral business when someone's looking to sell a catalog. And that's really the most important part of it for us. We're really cognizant that if we're going to say we're going to acquire a catalog, and assuming the due diligence checkout, we do that and sort of maintain that reputation. Particularly down in the U.S., where a lot of it seems to come from Los Angeles, Nashville, New York, or Miami on the Latin side, in some cases as well.
Guessing you spend all your time down there, David, at all the high-end parties, the Grammys, you name it, and start networking those people, or how?
You see invites, but you can only be in one place at a time. So go to a few of those, but you do have to have boots on the ground a little bit. And COVID in some ways was good for us, being in Calgary, although one of our advisors is in New York, who's connected in the music space, because you're able to develop these relationships quicker, faster than you otherwise would have. But I think it is still important to be in market. If nothing else, you were reminding people what you're doing, you exist, you're front of mind. going forward. And I guess the other derivative on the music side is, so everybody we know, it seems, who, whether they're in music or have nothing to do with music, they seem to be one or two steps removed from someone who's in a band or connected to an artist or doing this or doing that. So we also tend to see deal flow that can potentially come from people who just, their cousin is a songwriter, and, maybe they're looking to do something, even though the person themselves isn't at all connected to the music space. So
when you're purchasing these catalogs, are you going it alone, or are you part of a consortium? Do these catalogs get split up mostly, or are you picking an artist, you now own that artist catalog, and you're the only one who's receiving royalties on that, or are you part of a bigger conglomerate on these purchases?
When we acquire a catalog, we're typically acquiring some portion of the rights. For example, we might be acquiring the sound recordings or the royalties from the band themselves that recorded the music. But the songwriters might keep their own royalties. Or similarly, we might be buying it off a songwriter, or we might be buying the band's first 3 albums, but not their last 2 albums or their future albums. So what'll happen is we'll typically own 100% of what we buy, but that won't be all the royalties related to the artist themselves. It gets a little bit complicated to co-buy these assets. Like, we partner with somebody else to buy a particular stream. There's sort of an administrative side and an industry side where they're not as excited about splitting these contracts up and splitting the payments up and all those kind of things. It's all doable legally. It's just you're captive to someone else's administration. So we like to buy sort of 100% of certain tranches, but we're absolutely like to be partnered with others on it as well. So, and I think in most of our catalogs, you would see that. And in smaller, less known artists, we might own a larger piece, but in bigger artists where, say, we have rights to some John Legend, and we have rights to some early Taylor Swift albums. We have rights to some Tim McGraw and Faith Hill. Those sort of albums, we're very happy with our wedge, but there are definitely obviously other wedges out there that are larger than what we own in those particular mega artists.
We invite you to experience the melodic wonders of ICM Crescendo Music Royalty Fund's top songs on Spotify. To access this extraordinary musical journey, simply visit Spotify and search for ICM Crescendo Music Royalty Fund's top songs.
Songs would be in the catalog currently?
We would be in the thousands of songs themselves. And I think it's the way to look at it. We look at it more as how many catalogs do you have? So we've done 20 today. We have a few more that we should be announcing hopefully before the end of the year. And a catalog can be a lot of songs. So, for example, we bought master's rights off a violinist named Joshua Bell. Classical is a very small market, but when he's a top end violinist, and you think about that, he's got 500-600 songs in there because he's recording all these songs along the way. So no individual song really drives the catalog. We have other catalogs where it might be a single album. We're in the process of acquiring one that is a single song. We have to look at it, how it's concentrated in the entire portfolio. So that's a very different kind of acquisition. So when we think about the number of songs, people like to talk about it. I like to look at the number of actual catalogs, and we try and build it so that we've got some diversification in the actual portfolio itself. It's not all one genre or one artist or even one kind of royalty. And that's to just help protect us in the event that others are not, a certain artist falls out of favor or something like that. So Mike just pulled up on the screen. That's our portfolio composition as of March. You can see, country, rock, Latin, pop are the top 4 in that marketplace. That's not intentional, but the diversification is intentional. So that's going to continue to evolve. And yeah, as I said, the reason for it is we want to make sure we're not captive to consumers' listening taste changing. And if somebody stops listening to a particular genre or a particular artist, we have enough diversification that we can manage that. I think
and Dave, maybe I'll jump in here too. And
yeah, sure, Mike.
context to this bottom portion, because I think this is really important, going back to your comment on kind of our strategy on acquisition. What you're seeing here is diversification by age. And age is really important when you're underwriting these deals, because presumably something that is older in nature will have more predictability. So you'll see here that the vast majority of our portfolio is in that kind of 6 to 10, or even better, 10 plus years old in age. And to Dave's comment earlier, the strategy of our fund is not really to go and deploy capital into a way that says, okay, we believe that this artist is going to be the next latest and greatest. But a much better way to look at it would be kind of like this, right? Where you've got, typically when a song is recorded and released, you'll have a very large spike in popularity. You'll have a fall off in popularity. And then typically those years of, year 2, 3, 4 are actually on almost like a decay in the total streams, because people are, for lack of a better term, sick of that title after it's had its popularity. And then what you see is after, that kind of year 3, year 4, you see good catalogs actually start to accrete again, where the cash flow stream can actually start to grow over time. So for us, if we're acquiring things that are, in many cases, 10 plus years old, that gives us a lot of data to be able to look back at it and say, okay, we're comfortable paying this multiple to acquire this cash flow because we've got some certainty in the trailing cash flows, if that makes sense.
Yeah, that does make sense. You've got a song that you can think of songs that you hear still over and over again that are 10 years old. And that's kind of where the moneymaker is, I guess, because they're going to be consistently played. If they've been played for the last 10 years, why wouldn't they be played for the next 10?
Well, or when your kids start talking about some song that is from when you grew up and they think it's a brand new song.
Yeah.
That's when you know you've got a good one.
Or it's been remade in some way. And they're like, oh, this is a cool. I'm like, this is an old song, came out 25 years ago. They've just put a new beat to it.
That's called the TikTok effect.
Of course I have. Yeah.
That's TikTok effect. Yeah.
I mean, that's a really interesting point in terms of what's actually happening with consumers now too, right? So, I mean, obviously the era of buying CDs is largely dead. But in that era, people would have a finite budget. They'd buy what they would buy. They'd listen to what they would listen to, or whatever they could fit in the duffel bag in their car, in their CD changer. And that would be the extent of it. And the new music discovery would be limited to a pretty core group. And it's really, really changed with streaming and the algorithms, and also the user-generated content that's coming out of platforms like TikTok, where now you do have an entire new generation of people getting exposure to older artists, and we're getting exposure to newer artists, just depending on how it plays out. So the breadth of the listening has just changed pretty dramatically for the industry itself. And because you don't have to pay more to get new content, if you've got your subscription, you're more willing to listen to that content. So that's something that's really been changing just over the past 5 to 10 years here, and particularly in the last 5 years with the user generated content, which now TikTok is the number one discovery source for music for an entire generation, where they'll go to Spotify second after TikTok. So it's been a real change in terms of how this is being adopted and listened to and exposed for the entire next generation.
So it's obviously a really cool space. It's I think from our perspective as a portfolio manager perspective, and we're client facing people, it's something that's very easy to understand. So this morning I was driving my son to school, who's 11 years old, and I'm asking him, what's he doing today? And he asks me as well. And I'm like, well, I'm doing a podcast today on a new product we're looking at, and it's a music royalty fund. He says, what's that? And I told him, just broke it down very simply and said, well, you're taking part ownership in songs. So when you hear a song on the radio, you know how the artist gets paid when you listen to it? He's like, yeah. I said, well, as an investor, you get a sliver of that as well. So it's a way to take some ownership in it. And he's, like I say, 11 years old, not a savvy investor, and he understood it right away. So I think it's a really cool product that's easy to understand. But we've talked to Mike before about this product, and we're figuring that in terms of how it fits in a portfolio, it really is a true diversifier that isn't really related to or doesn't function in normal economic cycles. Like, do interest rates rising affect this investment, or what's going to affect it that could be a negative performance? Because I can't see what the downturn would be in something like this.
Yeah, I mean, the big reason, a handful of pensions got interested in this early on when they weren't talking about it was, as Mike said, you've got these long life assets, typically 70 years plus the life of the last artist. So, and you've got an asset that pays regardless of what's happening in the economy. So, one of the things that we have seen, been stress tested in COVID as an example, and in other recent drawdowns in the equity market, is it continues to chunk along and grow at a pretty steady rate, even though any individual song could do something else. And, that's because in the simplest terms, people are still listening to music, whether the economy is up or down, whether the stock market's up or down, whether the bond market's up or down. And then similarly, the cash flows we receive have nothing to do with, say, interest rates at all. So that is of great appeal to people within a broader portfolio. And you could call it an alternative income bucket. You can put it wherever you want, but it's a nice buffer. And particularly when we did see drawdowns in equities and bonds, as liquidity fell out of the system, it continued to do very, very well for people. Interest rates could affect the asset value, the terminal value, where people are buying or selling these assets for. We haven't seen a lot of pullback, but I think there's a scarcity in the assets themselves. So at the higher end, you've got a handful of very large players trying to buy as much of this as they can. And there's just a limit to how many times Bruce Springsteen can sell their catalog, or Bob Dylan can sell their catalog, or the Prince estate can do a deal, all those kind of things. So as a result, it only takes one buyer. But we look at it as a little bit more of a middle market approach, where we're trying to compete on smaller catalogs at what we would find as much more attractive valuations, meaning that our downside is very different with the rise in interest rates than what theirs would be if you don't do something new with that catalog or require some future catalog growth. So we haven't seen it yet really impact the valuations, but as if rates rise, I think in here it's fine, but if rates go up another 200 basis points, there's probably a little pullback, but with every asset class, again, I don't foresee that, but it's really just the terminal value of those assets when you sell them. The flip side is we should be able to buy assets at a more attractive price as well under those circumstances. The inflationary side of the market, that's brought up as a risk in some cases. In this case, we've seen the revenues have a reasonable amount of inflation protection. And one of the reasons why is the streaming providers can continue to increase their prices, and there's an inelasticity to people canceling their music subscriptions. We can treat video a little bit differently, but in the case of music, you have one subscription. Generally, you will listen to things multiple times. You'll listen to the same song multiple times. You might not watch the same Netflix series multiple times, as an example. So it acts a little bit differently. And the consumer is effectively calling this a utility bill. So if you went home to your 11-year-old son and said, well, economy's tough, we're going to make some pullbacks, let's cut our Spotify or Apple Music, that's not going to be well thought of within the family. I guarantee it. And Spotify just raised their prices for the first time in a very, very long time. And there is a view out there that they could raise, all these DSPs could raise them fairly materially, as long as they're not in a price war with another. So that passes through to the owners of these catalogs. So there is a reliance on these DSPs distributing this music and streaming continuing, which we do obviously believe we're not going back to sort of the dark ages of physical. Despite vinyl having a great resurgence, it still doesn't necessarily move the needle very much. And outside of that, the copyright, as we said, there's a regulatory side to this copyright royalty board increasing the rates for the songwriters. We think that trend is going to continue. I think it's probably bad politics to say we want to get more money to Amazon versus the songwriters out there. But if that goes in a different direction, then the revenues will go down. So, really from the risk profile, I think if you just own a catalog or two, your risk is someone isn't going to be listening to it as much. If you acquire, there's more risk certainly on new artists, because not only do they have to perform, and you have to fund them usually starting out, but there's a lot more music being uploaded every day, and a lot of it is sort of junk or never gets listened to. So you have to have a way to stand out. And whether you've already got your own career or your own marketing, you need to get to that ability to get that critical mass, because a lot of the music that it's very easy for someone to upload music right now, and a lot of it just won't get listened to. So, really ensuring that you have some relevance as an artist, that people will care enough to listen to you.
I mean, kind of how we're feeling about, how interest, how inflation, how the stock market, how the economy, has negligible effect on this. I mean, like anything, obviously high interest rates could impact, but like you said, if you're a levered purchaser, your interest rates might affect your ability to hold on to your catalogs.
Yeah.
If you're a pool, you don't have borrowed money. This is client money, and you can acquire away as long as the clients stay invested. So I would say probably the ultimate risk in this is just overpaying for a book in the run up in the prices to picking the wrong artist. I mean, ultimately those things would probably have the most impact on the valuation of this portfolio.
Yeah. If you overpay for a transaction, and, fortunately we've been at or above underwriting on everything to date, but that won't always be the case. So if you overpay for a transaction, it will take longer to pay that transaction back, and the cash flows coming back might be lower than what you expected. So your returns will become more muted. This particular fund can use up to 25% leverage. We currently have zero leverage in it, and been happy about that going forward. The industry itself will typically run 50 to 60%, or even some cases higher than that, because one of the features on these assets is once you acquire them, you don't have to put more money into them, and you don't have delays and things like that. So unlike, say, an operating business in the private equity world, where you can be in a loss position, or even development real estate, where you can have delays and cost overruns and all those things, we start getting paid usually within 3 months. So you do start seeing this cash flow right away. So as you said, if there was a dramatic overpaying, it would take longer to recycle that back. But again, there isn't a case where we have a capital call, so to speak, on these assets, which we do like a lot about it.
Yeah. You made a comment, this was earlier, and I had a question that tied into that comment. I mean, publicly in the last few years, obviously most people wouldn't understand how artists are paid and how who owns a catalog and things of this nature. And it kind of came to light through kind of some pretty public spats. But my question is, how many artists actually start out and get a contract and own their whole catalog from day one?
Very few. Yeah, very, very, very few. You can create an independent career now because of technology. Gives you both the ability to professionally record as well as distribute, and if you're savvy about it, market and build your own audience. So, we have a catalog with an electronic band called The Midnight, which a lot of people would have never heard of, but all of their fans are super loyal, super fans. So that core group of fans is really dedicated to it. So they've been able to build their career without going to a major label and taking all that sort of thing. But more often than not, it's just with the volume of stuff that gets released, you have to have a way to find and connect with an audience to make that work. So more often than not, an artist would sign a deal with a label. And if you sign a deal with a record label as a band, they're giving you a loan effectively that says, we're going to, write you a check for $500,000 or $300,000 or $1 million. You're going to go make these albums. We're going to market and help you build your career. And by the way, every dollar that you make comes back to us until this loan is recouped. And even after it's recouped, they will keep ownership of the quote masters for could be a fairly long period of time. So while the artist will get the royalties off the masters, ultimately the label will still own it. And this can be in larger cases. I don't know if you recall when Neil Young was in a spat with Spotify about Joe Rogan podcast. Neil pulled his recordings off of Spotify, but it wasn't actually Neil Young that did it. It was Warner that did that, who was Neil's label. And Warner could have made a different decision and said, we're going to keep those up there. Obviously, there's relationship and huge artist and all that kind of stuff. But so the label could have made a different decision than the artist, because even though Neil was earning the lion's share of the royalties, they still own those underlying copyrights. So that's one of the dynamics that can kind of happen there. But very few artists would own all their own stuff. I think artists are getting better at signing. They're getting better educated on the deals, because back in sort of the David Crosby days and everything else, you'd sign a record deal. You'd just be so happy to sign a record deal, and you may not have any understanding of the business side. And those record deals tend to favor the labels for a long time. So that's how it kind of goes.
Yeah.
Well, we've talked about kind of worst case scenarios for a product like this. What's the bull case? I know you very briefly touched on it earlier, David, about the fact that the vast majority of streaming is happening here in North America, mostly in the US. I would assume that this has got a lot of upward potential, just as other foreign countries come online with streaming and their access to streaming capabilities.
Yes, I think there's both sort of the volume and price case on the bull case here. So one of the as you said, in the US, the streaming markets in round numbers probably around 80%, but in the entire world it might be low 60s. In terms of some of the latest numbers. So what's happening is, while there's some saturation perhaps in the US, it's still growing, not at the same rate. The rest of the world is growing more. And that's everything from emerging markets to developed markets who are slower to adopt streaming as a model. And as a result of that, you not only get new music discovery, but you get more and more inherent subscriptions growing in the marketplace. So that is, I think, a big driver going forward of sort of the growth rate that the industry sees to continue to happen. I mean, that doesn't even factor in pure population growth as much as just adoption. And as that continues to happen, the other piece that's going on is the pricing side of the equation. And I mean, Spotify, like for the amount of entertainment value you get, it's the cheapest thing out there by far. And what's happening is again, once they've got sort of the customer base, there is some ability to raise pricing by these streaming providers without any material impact to consumers going forward. Again, video is a little different, because you might find you've got 7 video subscriptions with all bespoke content, but here you typically have 1 or 2. So we think that can continue to drive revenues for the industry going forward. And then thirdly, there's been a number of new platforms, and we've touched on some of them, which are all generating revenue. And these are platforms that didn't exist, some time ago. And that's everything from Peloton and the whole fitness side of it to gaming, things like Roblox and Twitch, to TikTok, obviously being, the big gorilla in the room, and these other platforms. So they have to go through a process of licensing the music, and then when it gets played, a royalty gets created, but also your audience discovery grows a lot. I think the last remaining social platform is Twitter or X, and there's actually a lawsuit that the Music Publishing Association in the US has launched and said effectively, Twitter or X has not been licensing music properly. So that'll be something to watch for as that goes forward. But effectively, both growth into different markets, growth of new platforms, and probably some things we won't even know exist or don't exist today will exist in 5 years. And then potential pricing increases all sort of lead to a growth expectation in the marketplace itself. And that doesn't even touch on the live part of the business, which isn't as big of a part of our revenue stream, but it certainly helps. But the live part of the business, which went to zero during COVID, is clearly booming and continuing to boom. And more people are looking for that experiential event, and they're willing to pay more for it, as evidenced for ticket prices for everything. And Taylor Swift's clearly the poster child what can go on there at this point in time.
Speaking of live events, I guess, over the years, obviously COVID kind of got things rolling a bit, but there appears to have been on different platforms, say a concert that's online that you pay for. How does that come through for a royalty if you own that music?
If you're the songwriter, yes, it would be treated as a performance of that music, and you would see some royalties from it. Again, the live for us doesn't drive it, but it certainly, in terms of the day-to-day knowledge, but it helps drive the audience growing as well. So in addition to that royalty, and this is why, back when you go see a concert, there's always a set list that they have to put in. They're not writing the set list because just to keep their fans interested. They're also writing it because the people who wrote those songs will be entitled to something like that going forward. And I think, the live side, the streamed events, we'll see how much they continue with the growth in the real live events. But, there were bands like BTS who were reaching millions and millions and millions of people. And there were people like Travis Scott on hip hop as an example of several who would do a concert within fortnight, and there would be 15 to 20 million people who would go view this. So it's substantial in terms of the audience and what they're looking for and adapting. And I'm interested to see. There's even some of the new venues we're seeing. I don't know if you've been following what's happening in Las Vegas, but they opened the Sphere, Madison Square Garden Entertainment did, and U2's doing a residency, and it's a fully immersive globe that cost them $2.3 billion to build, which is sold out, and selling advertising on top of it. So I think we could see a trend to different kinds of live entertainment like that, or even with ABBA over in Europe. ABBA's got a holographic show. I can't remember what it's called, but again, well received. People will pay to go see the holograms of ABBA do the performance in a specially built theater, and to kind of rave reviews. So I think it's pretty interesting in terms of what's going into some of these kind of new live venues these days, and the way they're being consumers getting really excited about it, and fans are getting excited about it.
I guess we're getting pretty close then here, but I one last question is, what's the expected income yield from an investment like this?
So we, at a fund level, we tend to distribute around 7%. It's possible to be a bit higher than that, depending on the income that comes in. When we acquire an asset level itself, we tend to look for returns, sort of IRRs in that kind of 10 to 20%. But it really depends on how new the catalog is. So if we buy an older catalog, that income might be very, very steady over time or accreting over time. If we buy a newer catalog, let's say it's 5 years old, when we underwrite it, we're probably underwriting some decline before it comes back, even though our expectation may be a little different than that. So we might have more cash flow coming in the early years and be forecasting less in later years. Now, the idea is that if that cash flow is actually going up before you think it is, that works out to a really, really nice return for us. But that's effectively, long term, plus or minus 10% is sort of the sweet spot for this kind of portfolio in an unlevered basis. Again, these assets are pretty stable and pretty steady. They're not like venture investing. We won't be up 100% in a year, but we also won't be down 50% in a year, the way these assets play out. So, and because they do generate this cash flow, we've got demonstrable data points as to how the catalogs are doing. Again, we don't want to get excited with one quarter over another quarter when these are very, very long life assets, but it does give us some data in terms of how these are performing in a very, very short period of time. So that feedback loop really helps us, I think, as well.
Yeah, that's excellent. A great overview of helping us understand this, David. We are nearing the end of our time, so wanted to thank you very much for sharing your viewpoints with us and giving us a kind of a peek behind the curtains on how this fund works. It was really fun to chat with you about it. And like I said, even my 11-year-old son can understand what's happening here. So maybe even buffoons like Dave and I on the PM side, client facing, can actually get into portfolios.
It's, because it touches everybody. people love to talk about the music, and they might not want to into the guts of the business side, but there's an emotional connection to it. So it is an interesting, it's very interesting from that perspective. And I think you won't find it being done in very many places as well. So really appreciate Tower Wealth and the Smokin Bulls podcast. And thanks again for having us on. That's great. Really appreciate the time.
Yeah, thank you again, guys. And thank you to Mike as well, our main support there at ICM. As I mentioned, we are Smokin Bulls. If you want to learn more about us, you can head over to smokinbulls.com. Follow us on social media. And if you like this podcast, please click to subscribe. Thanks again for joining us, everyone.
Thanks, guys.
Thanks for having us.